Hello everyone, my name is Thomas Punil and currently I am studying BTech Computer Science and Engineering BTech in Lovely Professional University Punjab, and I am doing specialization in Machine Learning and AML. This video is for an assignment that is for the subject Financial Introduction to Financial Markets, and I am presenting a detailed comparative analysis of three major financial instruments: equity shares, debt instruments and mutual funds. The entire analysis is based on authentic and updated information collected from NSE, RBI, and AMFI for the period ending December 2025. And the purpose is to understand how each instrument behaves in terms of risk, return, liquidity, taxation, and suitability for different investor types. Financial markets in India have grown massively over recent years, with rising retail participation and improved regulations. Equity markets now hold a market capitalization of more than 250 lakh crore. Mutual funds have crossed 35 lakh crore in assets under management. And the debt market continues to be one of the most stable parts of the financial ecosystem. In such a diverse environment, it becomes essential to evaluate financial instruments carefully before making investment decisions. This is exactly what this study aims to do. Starting with the equity instruments, I analyzed two leading companies, TCS and Reliance Industries. TCS is India's largest IT services company with a market cap of over 11 lakh crore rupees and an impressive return on equity of 46.46%. Its long history of consistent dividend payments and global presence makes it stable large cap stock with strong long-term potential. Reliance Industries, India's largest company by market cap, operates across refining, petrochemicals, telecom, retail and digital services. It has strong cash flows, regular dividend distributions and exposure to fast-growing sectors like 5G and renewable energy. Both companies offer good long-term prospects, but like all equities, they are subject to market volatility. They perform well over long-time horizons but may fluctuate in short term. So equity investments are ideal for investors seeking capital appreciation who can tolerate medium to high levels of risk. Next, I evaluated debt instruments, which focus more on safety, stability, and predictable income. Government securities, especially the 10-year-old GSEC, currently provides a yield of 6.53% per annum. They are backed by the Government of India, which means the credit risk is almost zero. These securities are almost highly liquid in the secondary market, allowing investors to buy and sell them easily. RBI floating rate savings bond, on the other hand, offers an interest of 8.05% for July to December 2025. The interest adjusts every 6 months based on national savings certificate rates, which helps protect investors against inflation. These bonds come with a guaranteed safety, and although they are not as liquid as G-Secs, they are excellent for generating stable income. Compared to equity, debt instruments provide lower returns but much higher security, making them ideal for investors with a low risk tolerance. Mutual funds, especially index funds such as Nifty 50 and Sensex index funds, offer a balance between diversification and long-term growth. The Nifty 50 index fund has a 5-year CAGR of around 15.55%, and the Sensex index fund has delivered similar long-term performance. These funds invest in top companies of the Indian market, and because they are passively managed, their expense ratios are very low. The index funds are suitable for long-term investment horizons, particularly for individuals who want to invest in market without selecting individual stocks. They provide exposure to market growth while spreading risk across multiple companies. Now, when comparing these instruments across multiple parameters, the differences become clearer. Equities have moderate to high risk but also highest potential returns. Debt instruments have very low risk and stable but limited returns. Mutual funds fall somewhere in between, offering strong returns with diversification benefits. Liquidity is excellent for both the equities and mutual funds, while debt instruments such as RBI bonds have restricted liquidity because they cannot freely trade it. Taxation varies. Long-term equity investments benefit from favorable capital gains tax rates, whereas interest income from debt instruments is taxed according to investors' income slab. Mutual funds also enjoy beneficial long-term indexation options. An important part of the report is mapping of these instruments to three investor personas: senior citizens, aggressive millennials, and middle-aged family persons. Senior citizens generally prefer predictable income and capital safety. For them, RBI floating rate bonds and government securities are highly suitable. They may hold a small amount of blue chip equity for dividend income but should avoid high volatility investments. Aggressive millennials, in contrast, have a long-term investment horizon and high risk tolerance. They are best suited for index funds like Nifty 50 and Sensex, along with a small portion of quality stocks such as TCS or Reliance. Over a 20 to 30 year period, compounding can create significant wealth for this group. Middle-aged investors usually need a balance of growth and stability. For them, a mix of equity and debt such as index funds, blue chip stocks, government securities, and floating rate bonds works best. This combination supports both wealth creation and risk management. Finally, the conclusion of the study emphasizes that no single instrument is perfect for every investor. Equity is ideal for long-term capitalization appreciation. Debt is essential for stability and income, while mutual funds provide diversification and consistent wealth building potentials. A disciplined approach involving systematic investing diversification across categories and periodic rebalancing helps investors achieve their financial goals more effectively. By aligning investments with personal risk tolerance, time horizon, and objectives, individuals across all age groups can build a strong and sustainable financial portfolio. Thank you for listening, and I hope this analysis clearly explained the strengths and differences of equity instruments, debt instruments, and mutual funds, and how each can support differential financial goals based on investor profiles. Thank you.